Welcome, everyone. Sorry for a few minutes delay there. We were just getting sorted out with our interpreters. And I'll just give everyone a few moments to arrive.
Sophia, where are you?
I'm sitting in Minneapolis today in Minnesota.
Great.
I-
Nice place. I went to McAllister in St. Paul years ago.
It's a great school, it's a proud legacy.
Hmm.
I think we're coming from all kinds of corners of the world today. Well, let me get started. I think some people are still coming through, but welcome everyone. Welcome to this webinar. We're very pleased to have you all here today. To go through some of the housekeeping first. So as a webinar, that means that all of your cameras and sounds are off, but please feel free to use the chat. You can share information there. You can share comments. If you want to introduce yourself, please, you're very welcome. We would request that you use the Q&A if you look at the bottom of your screen, and you may need to go to more if you don't see it in the initial lineup of icons. There's a Q&A channel with a question mark in it, and that's where we'll take questions. Um, and there's also closed captioning, I believe. Um, so you can show captions, CC, if you're having trouble following and want to read rather than just rely on your ears to hear what's happening. And finally, we have French interpretation. Nous avons aussi l'interprétation anglais et français. If you need interpretation, you go to the globe symbol, interpretation. C'est marqué interprétation en un cercle, une espèce de globe qui est là pour vous indiquer où écouter en français. Si aussi vous avez des questions à poser en français, servez-vous aussi du Q&A et vous pouvez écrire en français. On pourra traduire et aussi poser vos questions. Toutes les discussions, je crois, les présentations seront en anglais, mais l'interprétation est là pour vous aider à comprendre et aussi pour faciliter vos questions. So I'm just making it clear that if people have questions they want to write in French, they're welcome. Please use that Q&A channel. And with that, I think we can get started. Thanks, everybody. So before I turn to our chair, to our speakers, and to everyone, I wanted just to say a few words from IATP. My name is Sophia Murphy. I'm at the Institute for Agriculture and Trade Policy in Minneapolis, and we're very pleased today to be sharing this webinar with the AFSA, the African Food Sovereignty Alliance. And it's really Michael Farrelly and Karen Hansen-Kuhn who've orchestrated the project. I wanted to reflect just briefly on the report that Alex is going to present, to say that the 2010s, looking back, was an important moment for agriculture and its role in development in the sort of formal world that we're talking about today, how the World Bank and the government development partners saw agriculture. And you saw the share of money going into agriculture go from very little to a little bit more. And Alex has some of those numbers to show. And in that change, I think there was recognition that agriculture played a more important role than had been seen before in how countries develop. And at the same time, you saw the persistence of problematic frameworks and assumptions. And Alex is going to touch on many of those as well. I think the most promising change was some of the comprehensive social protection programs that understood how closely knit agriculture and food is in people's livelihoods and well-being. And the least were the kind of agripole export zones trying to increase the amount of agricultural commodity sold into international markets, where you saw, and again, as Alex is going to talk about, there was no addressing the questions of sovereign debt and the trap that that was holding governments and societies in. There was no discussion of corporate concentration and the failure of any benefit from economic growth to be shared. And there was no really addressing the lack of accountability in these public and yet closed institutions where power, even among governments, is highly unequal and where civil society has rarely had much ability to make an impact. As Alex will show, a lot of that money comes as loans and complicates the continuing issues of debt rather than changing that economic vulnerability that has done so much to increase poverty and to cause some of this environmental damage that we'll also talk about. So livestock is a new and complex layer. As we'll see, it is a scene for a lot of highly concentrated private company power. It's terrible for the environment when it's done in the wrong way. It has played and will continue to play an important role in everyone's livelihoods and diets even, but not at the scale and with the lack of ownership and agency and the lack of diversified food systems that the models we see from the IFIs have encouraged. So those are some of our concerns, motivations behind why we wanted to be part of this research. I should also acknowledge it was funded by the Tiny Beam Foundation that is consistently bringing attention to this question of industrializing livestock in developing countries and the big problems that raises from all kinds of social, ecological, and political points of view. Let me turn to Mariann Bassey Olsson, our first speaker. Mariann is a Nigerian lawyer, an environmental justice advocate, and food sovereignty campaigner with extensive experience in advancing agroecology, land rights, and sustainable food systems. She's the former chair of the Alliance for Food Sovereignty in Africa, AFSA, our co-host, and currently serves as the Deputy Executive Director of the Environmental Rights Action and Friends of the Earth Nigeria. She's also the Africa Coordinator for Stop Financing Factory Farming, known as S3F. Mariann, welcome.
Thank you so much. Good morning, good afternoon, and warm greetings to everyone joining us. There's an old saying that he who pays the piper calls the tune. In Africa, in African agriculture today, we must ask a simple question, but an uncomfortable question. Who is paying the piper? And whose tune are African farmers being asked to dance to? It's a pleasure to welcome you on behalf of the Alliance for Food Sovereignty in Africa, AFSA, and as a former chair of AFSA. AFSA collaborated with IATP on this report because we believe African civil society must follow the money. The future of African food systems is not shaped by ministries. It's also shaped in loan agreements, investments decisions, development finance strategies, and policy conditions that many citizens never see. These financial flows are not neutral. Money is never just money. It carries power, priorities, and politics. They carry a vision of agriculture. They determine which models are expanded, which companies are supported, which technologies are promoted, and which farmers, pastoralists, and communities are included or excluded. For many years, AFSA has challenged the Green Revolution model in Africa, its dependency on external inputs, corporate value chains, debt, monocultures, and the weakening of farmer-managed systems, local markets, and indigenous knowledge. Today, that same model is being renewed through development finance, now dressed in the language of climate action, job creation, digital innovation, artificial intelligence, and private sector investment. This is why the report is important. It shows that the World Bank Group is becoming a major force in African agriculture, including livestock. This is not simply about financing projects. It is about shaping policy, influencing markets, and determining the direction of African food systems. Livestock is deeply important in Africa. It is livelihood, culture, nutrition, savings, soil fertility, mobility, and resilience. For pastoralist communities, it is part of an entire way of life, rooted in knowledge, adaptation, and stewardship of ecosystems. For small-scale farmers, Livestock is often an integral component of diverse agroecological systems that sustain families and local economies. But when livestock is treated primarily as an industrial value chain, something important is lost. The animal becomes a production unit. The farmer becomes a supplier. The pastoralist becomes a problem to be managed. Local food systems become little more than raw material for corporate growth. AFSA has engaged in financial loss because food sovereignty is impossible if we do not ask, who finances agriculture? On what terms? For whose benefit? And with what consequences for farmers, women, youth, pastoralists, biodiversity, and climate justice? Public finance should support agroecology, pastoralism, local breeds, local feed systems, public extension services, territorial markets, and community control over resources. It should strengthen the people who feed Africa, not reorganize them into value chains they neither own nor control. This report helps us to ask the right questions. Are these investments reducing hunger or deepening dependency? Are they supporting farmers or serving agribusinesses' interest? Are they addressing climate change or merely repackaging industrial agriculture with new language? Africa needs investments, but investment must be accountable to people, communities, and ecosystems. It must be guided by those who produce food, not imposed by financial institutions and corporate interests. As we begin today's discussion, let us remember that the question before us is not whether Africa needs investment. It does. The real question is whether that investment will strengthen the sovereignty of our food systems or deepen our dependency, whether it will empower the people who feed Africa or who consolidate the power of those who profit from food. The choice being made today will shape the future of African agriculture for generations to come. So let us therefore engage boldly, question courageously, and remain steadfast in our commitment to food systems that are equitable, resilient, people-centered, and rooted in agroecology. Thank you to IATP, the researchers, AFSA colleagues, and all our speakers today, interpreters, and of course, the participants. The future of Africa's food system must not be decided for us. It must be shaped by us. Thank you, and I look forward to a rich and engaging discussion. Terrible. Thank you.
Thank you so much, Mariann. That was wonderful. Much appreciated opening. So we'll turn now to Alex. Alex Park is going to present his report, and then after to Lizah, Makombore, who's going to give us some comments and reflections on that before we open the floor at the end for some questions. Alex Park is an investigative journalist and researcher focused on global power, corporate investment, and food systems. His work on food and agriculture has appeared in Al Jazeera, The Smog, Africa as a Country, and many other publications. He's currently writing a book on the rise of the global fast food industry for Beacon Press. Alex, welcome and thank you.
Well, thank you so much for having me. Thank you, Mariann and Sophia, for that introduction. And thank you all for coming today. I'll just get my notes out really quick. So, the title of this report is this: "The Bank Takes the Lead," and I can discuss in a moment why I think that's appropriate here. When we're talking about livestock in Africa, the World Bank really should be a big part of that discussion. Recently, and I, um, my colleague Phil Howard of Michigan State University and I, we looked over the numbers to get a sense of exactly how much the World Bank Group was investing in African livestock. Before we get into that, though, I just wanted to share with you this chart that illustrates just how much the World Bank, which is one arm of the World Bank Group, as I'll discuss in a moment here, has been spending in agriculture broadly since 2014. So as you can see, from 2014 to 2020, there was only 1 year that the bank dispersed anything close to $2 billion to projects related to African agriculture. The average per year was a little over $1 billion. But then from 2021 to 2024, the average annual disbursement was over $3 billion. and 2024 is the last year for which we have a complete set of data. I'll also add that it was only in 2021 that the World Bank Group started to divide its investments by East and West, or East and Southern and West and Central Africa, and so that's why we have these like different color scheme here. Um, Now, looking ahead, we can expect those numbers to really go up some more. So, at its 2025 annual meetings, the World Bank Group announced plans to double its spending on agriculture worldwide, but with a focus on Africa. And that renewed interest is really significant in and of itself. But also, when we consider the wider context of this thing we call the Green Revolution in Africa, which started around 2010, the two entities that were really leading that charge were USAID and the Gates Foundation. And now USAID no longer exists thanks to the Trump administration and Elon Musk. And the Gates Foundation has experienced some very serious reputational harm as revelations have come out about that Bill Gates was very close to Jeffrey Epstein. And at the same time, a number of European development agencies have scaled back their commitments as those countries have turned their focus more towards defense spending. So given everything that's happening around the world, I think it's really safe to say that the World Bank Group is really taking the lead in the African Green Revolution. But before we talk about the nature of the World Bank Group's investments, we should talk about just the nature of the organization. The World Bank Group is the largest and most influential of what are commonly called the development finance institutions, or DFIs. And it's not really a bank in itself so much as the parent organization of several banks. So the IFC is covers the private sector. It's a private sector lender. It provides debt financing to companies. The World Bank is kind of on the opposite side of things. It's the government lender. The World Bank is kind of subdivided into a couple of different agencies. One is called the International Development Agency. The other is the International Bank for Reconstruction and Development. And the jurisdictions of those two entities correspond to the development level of the countries that they work with. And now all the projects that we looked at fell under the IDA. That's the International Development Agency. Separately, there is also the Multilateral Investment Guarantee Agency. That's sort of an insurance company. It is a kind of a backstop for other lenders to allow them to encourage them to lend more money to various projects. And then there's also the ICSID. That's not a bank, but an arbitration platform. And we won't be discussing that today, and I don't get into it in the report. Um, Looking now at where the money is going within the livestock sector specifically, livestock as a subset of agriculture. Um, you can see here this is the World Bank Group again, or I'm sorry, actually this is the IFC. Um, the IFC. So from 2014 to 2020, um, the IFC committed very little to poultry. Most of the capital they were devoting to livestock went into kind of more the processing side. Three of the companies they invested in, the ones that make up the blue bars on the left here, were involved in producing powdered milk and bouillon. But starting in 2021, things started to really change. As you can see, they started investing in poultry in a really big way at that time. So during this time, they committed to poultry production in six different companies in Africa. And the transformative potential for those projects is really enormous. They're very large companies, and they're also some of them are they export to neighboring countries. Um, they are connected in various ways to different value chains through supermarkets or through fast food chains in some cases. Now, I'll just make a brief technical note. This chart is looking at commitments or the capital promised. The other one we were looking at a couple slides before this was looking at disbursements or the capital spent. And we couldn't get disbursement figures just for livestock or commitment figures for everything. the bank just doesn't make those figures available, and they wouldn't entertain our many requests to speak with us. So that's why we're using different terminology here, and why the numbers don't quite align by year. So commitments made in 1 year won't become disbursements for another year or two, which is why in 2020 the commitments were quite substantial, even though the bank did not spend tons that year. The commitment made registered as a disbursement a couple of years later. Now, I mentioned the IFC became more interested in poultry starting around 2021. Looking at livestock broadly, you can see that the World Bank, so that's the government lender, their commitments also went around during this time. When we're talking about World Bank projects, um, the money can cover a lot of different areas. And so this is a spending breakdown for a project in Rwanda. As you can see, 40% of the $56 million that the bank committed was for public administration. A lot more capital went into crop production. And while based on the description, it seems the entire project was oriented towards elevating the livestock sector. Only 7% of the capital within that project went to livestock specifically. And so this breakdown is pretty typical of World Bank livestock projects. And I think it speaks to how the bank and the group behind it really understands livestock, as I'll discuss in a moment. This project is interesting, and I think it's illustrative in a way because this project it was very much, well, to hear the bank describe it, it was very aligned with the development goals of the Rwandan government. And the idea, they said specifically, they said explicitly in this project that the idea was to reduce the number of farmers in Rwanda, reduce the number of farmers involved in livestock even, um, because it was facilitating the creation of value chains and then also kind of there's a lot of facilitation of the processing side of livestock to really elevate those farmers that they had kind of identified as being especially productive and well capitalized, and then kind of like helping them even more, um, specifically with the intent of kind of phasing out, removing, making livestock less viable as a source of income, as a lifestyle, etc., for smaller farmers. And so the bank said that explicitly in the case of this project. They don't say it so explicitly in other projects, but generally it is illustrative of kind of how the bank sees things. And as I say, it kind of speaks to how they see livestock fitting within the kind of wider development platform that they're offering. So as you can see from this chart, very few projects commit more than 50% of their allotted capital directly to livestock. And what's important to remember here is that the underlying theory behind the African Green Revolution has always been that countries start as agrarian countries, but develop is to industrialize. And it is inherently is going from farming to going into factories and production, manufacturing. That's a theory that the World Bank Group has always been quite comfortable with, since they were one of the pioneers of this theory. And as I see it, development is it's really a fundamental movement of people from what they call low productivity sectors like agriculture into high productivity sectors like manufacturing. So livestock production bridges those two poles of an economy. It's a way to turn an agrarian sector into a manufacturing one. And I think part of the appeal for poultry in particular is not just that poultry is popular, so poultry producers are well poised to grow, but that it is an especially technology intensive subsector within livestock. It's also very concentrated physically, so it takes less land, and partly for that reason, it's an industry that can happen in a lot more places than beef can, for instance. And then pork also is something that you don't see the World Bank Group really invest in really at all in sub-Saharan Africa because for largely because of religious reasons. But even if the country itself isn't like largely Muslim country, it is they they put a high value on projects and companies that have export potential, and so typically pork production doesn't have a great deal of export potential. So now this is a map where livestock and related projects, such as projects related to, for instance, veterinary medicines and also feed crops are located. Um, and this is for both the IFC and the World Bank. As you can see, the World Bank Group has definitely invested heavily in South Africa, but they haven't limited themselves to those higher income countries. So Namibia, Botswana, Angola, these aren't on the list at all. And there are more projects going on in Niger than in Cote d'Ivoire. Now, this is number of projects. This isn't the capital committed. Since 2015, poultry operations have been really all over the place. Um, Seven poultry companies in seven countries have attracted IFC investment during this time. And so those countries are Senegal, Madagascar, Zambia, Mauritania, Ethiopia, Mozambique, and Uganda. Uganda project, I should say, is on hold. It doesn't look like it's going to happen with the IFC support. But so as you can see, like poultry is kind of like the within livestock, and I think, well, agriculture is definitely a kind of a rising area of interest within the World Bank Group. Within that, livestock is definitely a big part, and within livestock, poultry is maybe the area that they are most interested in right now. And it is their kind of their involvement with livestock and with poultry, especially it's distributed all over Africa. Um, and they really do see it as a kind of a mode for development, a way to carry out their mandate, which is essentially to kind of uplift and help countries develop. It isn't just about kind of like going to those countries where the export potential is highest, where the development potential is highest. They see it as a kind of they see themselves as benefiting really every country in Africa that can take it, which as I see it is most countries in sub-Saharan Africa. So what can we expect from the World Bank Group as it increases its support? And recall, they as in their annual meetings in 2025, they said they plan to double their commitment to agriculture, with a focus on Africa. So the group has lately put a lot of emphasis on new technology, especially AI. This was a still from a presentation during their annual meetings. It's not my graphic. As you can see, they made this really bizarre claim that AI could reduce water for rice farming by 30%. And I say this is bizarre because AI data centers are extreme water sucks. So even if it doesn't make irrigation more efficient, you can expect it to draw down some aquifers somewhere else. And all that may sound new, AI, all this, kind of new technology. But that kind of talk has a long history among advocates for the Green Revolution in Africa. The World Bank Group and other development agencies have touted various technological silver bullets over the years in African agriculture, including AI. Raj Shah, who currently leads the Rockefeller Foundation and was talking in before that he led USAID. Before that he was at the Gates Foundation. He was actually talking about AI specifically as far back as 2018 and probably before that. Um, but I just bring this up because this kind of talk gets a lot of buzz, and to the right audience, it sounds pretty exciting. But I suspect it will play a really limited role in the group's future expenditures. Doubling investment isn't a time to do something radically different or untested. It's really a chance to do more of what the World Bank and the IFC have already decided is working. That means more livestock projects and likely more poultry projects, especially. Anyway, that's it for me, but I look forward to your questions. And if you have any more questions that you want to talk over after today, please feel free to email me, or can contact me through my website, and that information is on screen right now.
And we can be sure to share. Alex, thank you so much. It reminds me of things I didn't say at the beginning, but the meeting is being recorded. You'll have seen that when you joined the Zoom, and we will share that recording afterwards and the slides with it. So thank you. That was terrific. A reminder to everyone, and I can see the questions are starting to come in. There's a Q&A function where you can put any questions that you have. Même chose en français. Si vous voulez poser vos questions en français, vous pouvez vous servir aussi du Q&A et on pourra les poser aussi. N'hésitez pas d'écrire en français. Let me then turn to Lizah. Lizah Makombore is a doctoral researcher at the University of Vermont. She's examining the future of farming and conservation finance in the context of climate change. Her work explores how ecological economics can inform more inclusive financial and policy systems to sustain the well-being of diverse farmers at the center of resilient and equitable agroecosystems. Lizah is studying how public policy and global institutions, such as the World Bank Group, shape agricultural transformation, land reform, and rural livelihoods. Lizah, over to you. Thank you.
Thank you, Sophie, and thank you to Mariann and Alex for setting a context and for delivering the report. And thank you to the organizers for creating this important space for dialogue. And I would like to point out that my reflections today are informed by the report that Alex has just presented, and also by my broader research on agroecology and public development banks undertaken with my advisor, Colin Anderson, and colleagues at the University of Vermont's Institute for Agroecology. So as a researcher working at the intersection of ecological economics, agroecology, and development finance, I approach this report through two questions. One is, what kind of a livestock future are these banks and governments helping to create in Africa? And the second question is, can agroecology provide a viable alternative framework for guiding agricultural investment and food systems transformation? So these questions matter because development finance is not neutral. I think Mariann did a great analysis of how these institutions are not neutral. So they are shaping our agricultural systems in the way that they support or do not support certain agricultural systems. So in practice, development finance often favor large-scale, investor-friendly models that tend to privilege industrial livestock systems over the pastoral and smallholder systems upon which millions of Africans depend on. So my first reflection one, is rethinking the Green Revolution model. And my first reflection is that the report arrives at a critical moment for assessing the Green Revolution model in Africa. For decades, agricultural development has been guided by the assumption that increasing productivity, commercialization, integrations into global markets would reduce poverty and hunger. This paradigm continues to shape policies, financing mechanisms, subsidies, technological investments across the continent, including support for the fourth industrial revolution. We heard about AI just now and how it's being used in this narrative, and also initiatives such as the AGRA, the Alliance for the Green Revolution in Africa. Yet independent evaluations have found that AGRA has not achieved its core objectives of significantly improving smallholder income or reducing food insecurity. So if productivity growth alone has not delivered food security, resilience, and prosperity, then perhaps the challenge is not the amount of investment, but in the assumptions underpinning those investments. So we hear the World Bank speaking about the financing gap and how there's this myth of scarcity of financing. But here we are saying perhaps that's not the issue. Let's challenge that. Let's re-look into that. So within the livestock sector, this productivity-oriented logic is reinforced by the belief that increasing animal protein production is central to agricultural development, while nutrition sciences has evolved towards a more nuanced understanding of healthy diets, nutritional adequacy, and development finance institutions continue to prioritize industrial livestock expansion in practice. So historically, in line with the Green Revolution thinking, development finance institutions have tended to reduce livestock systems to a narrow set of productivity and efficiency metrics. Most notably in livestock industrial production is greenhouse gas emissions per unit of output. Such approaches often overlook the diversity, multifunctionality, and socio-ecological contributions of livestock systems across Africa. So when we look at agro-silvopastoral systems, multi-paddock grazing, pastoralist livelihoods, and agricultural livestock models, they provide benefits that extend beyond production alone, including biodiversity conservation, landscape stewardship, cultural heritage, and ecosystem regeneration. Yet these dimensions are rarely captured in the conventional appraisals that these banks use. As a result, what gets measured is often what gets funded. And what gets funded increasingly reflects a narrow vision of livestock development rather than the diversity of pathways available for building resilient and sustainable food systems. So that's generally my first analysis of how AGRA is manifesting or being implemented by the banks. The second reflection is what kind of livestock systems are being financed. And my second reflection concerns the nature of livestock investments themselves. Livestock play a critical role across Africa. It supports livelihoods, nutrition, savings, culture, and resilience. So the question is not whether livestock should be supported. The question is what kind of livestock system are being financed. So the report suggests that development finance continues to favor industrial intensification while providing comparatively limited support for agroecological alternatives, such as pastoral systems, silvopastoral systems, and community-based livestock management. This creates a contradiction. On one hand, the development institutions are saying we support systems that contribute to the challenges that we face today, such as your social, cultural, and ecological dimensions. But on the other hand, they are really continuing to support and contribute to the same challenges and often overlooking the multidimensional livestock systems that are agroecological. So the result is what we call social dilemmas in economics, where we find that short-term productivity gains may come at the expense of long-term ecological resilience. So Africa cannot afford development pathways that degrade soils, erode biodiversity, and increase vulnerability to climate change. And thirdly, my last reflection is, can development finance become more agroecological? And too often agroecology is treated as a niche alternative requiring special funding, windows, and pilot projects. And I would argue that the challenge is much larger. The question is not simply how to finance agroecology. The question is whether development finance institutions themselves can become more agroecological. Agroecology is more than a set of farming practices. It is a framework that recognizes that relationship between people, systems, economies, knowledge systems, and communities matter. So the HLP's 13 principles for agroecology often offer a useful guide. They emphasize biodiversity, participation, fairness, co-creation of knowledge, and responsible governance. Imagine if these principles informed project appraisals, risk assessment, and investment decisions for the banks. Imagine if success were measured not only by productivity and financial returns, but also by soil health, biodiversity, community well-being, equity, and resilience. That would really represent a transformative approach to development finance. So in conclusion, I would like to conclude with a thought grounded in Ubuntu, which is an African cosmology, which is projected by the Afrozi I am because we are, centering we. Ubuntu reminds us that our well-being is inseparable from the well-being of others. In ecological terms, it reminds us that human flourishing depends upon the flourishing of the ecosystems that sustain life. From this perspective, agroecological investments should not only maximize production, they should strengthen relationships, benefit people, benefit communities, ecosystems between present and future generations. Ultimately, the question is not whether Africa needs more investment. It certainly does. The question is whether these investments will support a transition towards food systems that are ecologically sustainable, socially just, culturally grounded, resilient enough to meet the challenges of the 21st century. The bank takes the lead, provides an important opportunity to advance that conversation. Thank you, Nyabonga Datenda.
Thank you so much, Lizah. That was fabulous. You can see all the reactions floating up the screen in our Zoom fashion. That was great. We've got a series of questions. So we've got the international financial institutions, in particular the World Bank Group, as a driving force. Its unquestioning and outdated economic assumptions on display. Its failure to address questions of accountability, questions of control, but also questions of the vision. What do people want? And as Mariann started us out with saying, well, how is Africa defining its food future and what is Africa asking for? And we have these particularly, they're not just unaccountable to the places where they're spending their money, but they're also impregnable to change. They're not adaptive because they're not getting the feedback that they need, I would argue. And I also just want to pick up on one piece that Lizah made me think about, this problem of what we sometimes call carbon tunnel vision. If you go in looking for greenhouse gas changes, you can cause quite a lot of damage. You're trying to reduce emissions, but not looking at anything else happening. If you go in trying to uphold biodiversity and all of the principles around it, you will generally reduce your greenhouse gas emissions as well. But in the process, you will have done something that farmers will be interested in and benefiting from, and that all of us more broadly as well will benefit from. And I honestly think it's because it's hard to model, simply hard to put into the way that they like to think about the economy, that reduces it to something so simplistic and ultimately damaging. Anyway, with that, let me turn to our questions. So the Q&A est à répéter une fois de plus. Si vous voulez poser vos questions, n'hésitez pas d'écrire en français. And I think I'm not going to quite take them in order. There was a question from Rachel Mason, who was saying, could you, and I think Alex to you, can you paint a more detailed picture for someone who doesn't really deal in the world of business and investment? What does a poultry investment look like? Is it lending money to a government or to a company? Is it to build a facility, for example? So who spends the money on what concretely? Can we make that a little bit more tangible for the audience?
Sure, that's a good question. Um, so the poultry comes through most explicitly and most obviously on the IFC side. So that's the private sector lender of the World Bank Group. They are on the hunt for poultry companies and then they invest in them. So generally, though, what that looks like, I mean, to your question, typically project per project, it tends to result that kind of investment. It tends to result in more facilities or expanded facilities. Um, Very often it's a company that exists in um, maybe it's in one country and then they have a kind of an expanded facility that will be more oriented towards exports into other countries. The case of there's one called Country Bird in South Africa. They were very big in South Africa and they exported around to Botswana and um, I think Namibia, but then they wanted to build a facility in Zambia. They built a facility in Zambia. In that case, also the World Bank loan or the World Bank Group, the IFC, helped them to build a new facility in Zambia. And then also having had that money, received that money, they were also able to dedicate their own capital for a project that was not funded by the IFC. So they went out and acquired another plant and another facility in Nigeria. And so the IFC was instrumental in them not expanding not just into Zambia, but really I would say expanding into West Africa and to Nigeria as well. Um, Now, that's the IFC. The IFC investments are generally kind of a lot easier to make sense of, and the World Bank is it's different, and so that's where you see more of these projects where it's like the sums are much greater. They can be in, tens of millions of dollars, or even I think they're as high as like close to 100 million. And then much of that money is going into the government. It's kind of shoring up a like a one or two different ministries that are involved with kind of like regulating, facilitating livestock production of some sort. Um, Money can even go into like education, and then it can go into kind of like crops and other kind of you know other areas that are related to livestock, like we saw with that one Rwanda project. This is interesting, I think, as Sophia mentioned, because like I mean, these banks the World Bank was involved in the structural adjustment in African countries, and kind of they told them like you will reduce your civil service, you'll reduce the size of your government, and then we'll give you money. And now they're saying we'll give you money so that you can build up your civil service, but they're building up a civil service that is specifically oriented towards these kinds of very kind of specific outcomes around livestock production with these livestock projects. Of course, they lend money for other reasons and to other projects. But it's not like money to a government to kind of build up their civil service generally and their agriculture sector generally. It is something specific with a specific outcome around value chains around livestock in this case. So long-winded answer, but important question. Thank you for it.
I think it is important, especially that question of whether you're building capacity for countries to have autonomy or whether you're specifically financing a sector where all of the power is already distributed. There
Yeah.
are a couple more questions in that vein, Alex, if you've and I'll just take them. So the first was from Mary Hildebar about when you're speaking about investment, and I think you did try to say this as you spoke, is it loans or grants? It's both, isn't it? But and different parts of the group have different rules on how that is. But maybe you can say a little bit more about where most of those numbers were coming from, loans or grants. What are the interest rates, and can individual farmers access it? I think it can anyway. And the second question, which is from the chat. Although I encourage everyone to use the Q&A, it's hard to monitor all these things. Do we know whether the bulk of projects receiving funding from the IFIs for expansion are African owned or international corporations? Are there any stipulations on the ownership structure to receive funding?
Yeah, those are good questions also. So, generally speaking, the World Bank deals in debt, the IFC deals in debt and equity. And so I'll discuss that a little bit, but in either case, these are pretty low interest loans. And so that's why certainly for a private entity, it's a very desirable financing scheme. I mean, because the sums can be pretty substantial, and because also the interest rates are low, and then also because, kind of a third factor, which is maybe unrelated to well, it's related to that question, but also because the IFC, because they have this reputation for kind of screening their projects, um, in such a way that other banks would kind of I mean it is a seal of approval that any other bank really anywhere in the world will recognize as like, okay, this is a legitimate company, and this is a company, whether independent of whether it's a good investment or not, it is not an investment that would result in a reputational risk. It's not a company they can, assume that is doing some kind of like really like horrendous human rights violations. That's a company could be committing some horrendous human rights violations. But if the IFC has cut it a fat check to expand, to double its facilities, to double size of its facilities, then no other bank in the world, no other bank in Johannesburg or Lagos, could really like kind of suffer the harms or get in trouble with its own clientele for also lending to that bank if the IFC lending to a company if the IFC also lent to it. Now that said, um, yeah, so the companies that they are like, I'm not sure if it's an internal rule, but it's certainly kind of an unspoken. Well, it is a desire that IFC people express publicly that they want local companies. They want locally controlled companies, and their track record really, as far back as we looked, and even before that, they are local companies. They are companies that are controlled by local elites that are often very politically connected, but they are local companies. Kind of um, what is even more desirable, as I see it, is kind of like companies that are investing in other countries in Africa or in other developing countries around the world. This is what they call South-South investment, that kind of thing. Um, but yeah, generally what they're looking for though are, like companies that may be locally controlled, but are very much modeled after a model that you would find in the United States or Europe or China. So this kind of poultry production, to revisit that subject, that model was really pioneered really in the American South. I mean, in states like Georgia and Alabama. I mean, that's kind of where our kind of industrial model of poultry production emerges. The Netherlands has also become very good at it since the 50s and 60s. It's the model that exists in China. And so now kind of as far as the World Bank Group is concerned, there's basically only one way to raise poultry that they consider, legitimate or worth financing, and that is that model. And so they may be local companies, but they're companies that are very much modeled after this other model, not a local model.
Thanks for that, Alex. Lizah, did you want to add something?
Yes, no, I just wanted to compliment some of Alex's answers to the question around the financing mechanisms, but thinking of it from like it's a financing landscape. So you have the sources of the financing. Is it a multilateral development bank? Is it a blended finance where you have governments also coming in, you have ODA, is it official development assistance, but then that translates into the different financing mechanisms that we get into this space. So you can have a trust fund, for example, where the World Bank will be like a trustee, like the GAF PSA, Global Agricultural Food Security Program, where then the trust fund is then managed and through producer organization, and that's like direct investments, and those will be mostly grants and non-reimbursable sort of loans, but you get other specific arrangements depending on what the sources are, where the financing mechanism can be like a payments for ecosystem services, which is like performance-based, funding models. You get all sorts of modeling, but I think what Alex really wants to also highlight here is the logic of the investment, which looks at return on investment. It looks at, number of jobs, for example, that are being created. So it ends up aligning more with corporate consolidated companies. So they could be local, but still they are the same companies who are sort of following this productivist sort of model. So, and sometimes it's a mixture, like you said, it could be grants and loans and concessional loans. So it plays out within that particular landscape. And again, that myth that I spoke about, where you find the World Bank trying to get more private sector participation because there's this myth that there's not enough funding, yet it's the assumption that they are using to fund that are problematic or that we are trying to really understand and address. So the financing mechanism is really dependent on the whole financing landscape. Yeah, thank you.
Yeah. And if I could add one more thing, Liza, I mentioned that the IFC invests in they have equity investments also. And so that speaks to your point that like they are looking for like profitable companies. I mean, any
Yes.
lender is going to look for a profitable company generally. They want their loan back. But in the case of an equity investment, I mean, the bank, the IFC, is taking what they would consider an ownership stake of a company. And so then as an investor, they can install their own people on the board, they can kind of install their own people in management, and they can say, you will do this. So it's not just that like, well, we wish you good luck and we hope you
Mm.
do well, and in any case you'll pay back your loan. They're getting in there and they're saying like, okay, now you're going to make money and this is how you're going to make money and we're going to make sure you make
Mm.
money because we have skin in this game and your success is essential to us.
I think I'm going to take from there. There's a few different points and questions coming from Taylor Quinn about, claiming the World Bank is open to change, noting that the bank, you need a certain scale of investment, and do the projects, the agroecology projects, are they available at scale? There's a lot that we could say about it, but maybe, I mean, I would make 2 points. Maybe a few points could be made. One is it's a complex institution, which Alex started out by showing, and the scale of money available to the different parts of the World Bank group are very different. And in my experience, the smaller the loan and the more soft the terms, the less influential it is on the decision making that is happening at the center. And the more the money, the scale of the project grows, usually the more commercial the terms, and usually the less you'll see any kind of um, role for other stakeholders. And I would underline also how the bank makes decisions. It's very simple. The more money you put in, the more say you have in the voting. So, but maybe others would want to say something. It is obviously complex, and it is not the only actor. Alex is pointing out that they operate in a commercial environment. That it's not as if the World Bank controls the world economic environment in which they're trying to succeed.
Yeah, I think that the notion of scalability it is, I mean, it is something that, yeah, we would like to see that kind of like we would love to see that like the World Bank for all its resources and the World Bank Group could invest in agroecology projects. I do kind of question whether that is viable just kind of within, I mean, with that, if that is, it is possible to kind of fit agroecology within the framework that, as you point out, kind of within the framework that the World Bank kind of, the way that they're set up to even think things and kind of approach things. They value scale, they value size, they kind of see scale and size as an end to itself. And so they're looking for between a project that can kind of influence like 100 people in a small area and one that can influence, 50,000 people in a very large area, even if it's influencing them very, very little. Even if it's kind of, but the numbers they toss out are really substantial and they can say like, well, that this project will kind of touch like, 10 million farmers or something like that. But what those numbers are kind of that's constantly what they're looking for is kind of ways to kind of to touch just millions of farmers at a given time through a single project that they can whose stakeholders they can fit in a conference room. I mean, that's their mode of thinking. And so it's easy to see how kind of an industrial project can fit into that, can fit within kind of the framework, that framework. It's harder to see how an agroecology project, because of their nature, because they are kind of necessarily so spread out, involve so many different people, because they touch so many different um, sectors, how that fits within the World Bank group. Um,
Lizah, let me pose another question, which I think will let you probably come back the same way, and we'll get this will probably be the last round of questions before we also give you time to make closing remarks. So there'll be two opportunities. And I'm sorry, I'm going to blur a few different things together, but questions around Lizah, can you expand on what an agroecological approach to livestock production and support would actually look like? So apart from pastoralism, say for a small scale farm or a diverse farm, um, how is that integrated? And I think the flip side of that is one of the first questions we had. How explicitly is this model where they talk about reducing the number of farmers in Rwanda based on an assumption that the US model of agriculture, where farmers are a vanishingly small share of the population, is the ultimate goal. So those are the flip sides, I guess, so how much is that model still holding on the one side, and what is it we're investing in on the other, Lizah, if we're thinking about agroecological investment?
Awesome. It's in line with what I wanted to add on. So thank you, Sophie. I want to give an example of an agroecology project that is a case study in another report that we published, myself and Colin Anderson, in 2025. It's called Ecoforte, and I think it's in it was in Brazil, where we had so when we're talking about scaling, I think the challenge is we think scaling is just like growing global, like being able to export markets, and I think that's the trap that the World Bank also finds itself. But in that particular project, scaling meant territorial markets, which is something I think the Mariann spoke about earlier on. So how can we scale, if you want, wide or scale out instead of scaling up? So in that particular project, it was really focusing on two modalities, which was funding of networks, so networks of farmers within that particular region. So it was farmers who were doing more of your geese type of farming, so it's a different poultry, but it's still poultry, and it's culturally significant within that particular region. And then, bringing and funding the networks meant funding shared infrastructure. It meant funding women, so there was a gender component to it, and funding preschools for women so that they could improve their productivity on the farm, and also funding networks that helped to reach out to the territory and infrastructure that helped that in any case. And then the second part of the modality, the second modality was funding for market access, which was now loans. The first part, it was mostly guarantees and non-reimbursable loans. So I think that can be an approach that we can take to agroecological livestock production. So really thinking about what do we mean by scaling in a particular context. And agroecology is it's not only knowledge expensive, knowledge intensive, it is also about context, right? So really thinking about the context and then what does that mean in terms of scaling. So we are busy in phase 2 of that particular research, really looking at what are these solutions, what do they look like, and what does financing mean, in that particular context. Thank you.
Thanks so much for that example, Lizah. I think we still have more questions, but I think we're going to kind of move towards maybe some closing thoughts. We have another very clear question from Rachel Mason about responding to the argument that industrial livestock may have problems, but it reduces malnutrition, provides jobs, and that's what we need. So I guess these are the age-old fights, is probably say some reflections around that. This question that we keep circling around. What are the assumptions eventually of what is a good economy? But I'm going to offer each of the three of you another chance to say something in conclusion and just say, I hope we'll advertise our podcast. IATP has just released the fifth and final episode of our podcast on agroecology, and encourage you to look at the chat. Michael Farrelly from AFSA has been sharing on some of the different scaled agroecology experiences we have. And then maybe I'll start again with you, Mariann. Did you want to say something here as
Yeah,
well?
thank you so much for everyone who has joined us today. And we are doing this because we need not just to, when investments come to any of our communities, we should learn to interrogate what is being offered as positive gains and whether it will empower our people or feed our people or consolidate the power of those who profit from our food. So again, I'll end by saying that the future of African food system never must not be decided for us. It must be shaped by us. Thank you so much.
Thank you, Mariann. And Alex?
Yeah, I would just say that I think there are um it is a question of power. It is a question not just of resources. I mean, the question of resources is certainly related to the question of power, but I think as Sophia said, there is a it is a concentration of power, and there's a kind of, and it's about also how the people who hold power, the institutions that hold power, kind of take in information, retain information, and what are those channels to kind of to provide information to them, and if those channels are available, will they even listen to them? I think those are open questions. But I think it is also it's something that we all have to keep in mind as we kind of promote agroecology and talk about it's very real, very well documented benefits. The question of, I mean, all of those kinds of questions about how to kind of advance those projects and how to kind of get them through an institution like the World Bank. I mean, they necessarily have to grapple with questions of who has the power in that situation and who has the power to speak in within that context. Um, so.
Thanks so much, Alex. And Liza, did you?
So my final reflection just concerns opportunity. I think I want to live with the premise that a different future is possible for Africa, livestock agriculture, and that Africa is not simply facing an agricultural challenge. Africa has an opportunity to build food systems that are fundamentally different from those that emerged through the industrial agricultural development elsewhere. So we need to move away from a cookie cutter sort of development finance perspective, and there's enormous potential to support territorial markets, like we said, indigenous foods, agroforestry systems, farmer organizations, and locally adapted innovation. There's also an opportunity to promote healthier diets whilst reducing dependence on industrial food systems. So the question is whether development finance will help unlock this potential or continue to reinforce existing models. Thank you.
Thank you, Liza. Thank you, everyone. I think these are really the critical things to take away. The power and who has it, voice and who's heard, the need for agroecological institutions, not just for money, and how to think about the context in which investment is provided. And we've just had such a rich exposure there to some of the ways it works and maybe shouldn't, and also the possibilities for doing it differently. There's a lot to learn from the mess that we are in this country with its agriculture, and that's another part of IATP's work. We have a lot to learn from Africa on how to change and learn again lessons on how agriculture might be sustainable here. So really welcome this chance to learn from everyone today. Thank you, everyone. The questions that weren't answered, we will do our best to follow up with you on those, and the recording will be available. Merci aux interprètes. Thank you very much to the interpreters for making this happen, and to all of the staff behind the scenes as well that put on the webinar. Bonne journée tout le monde. Have a great day.